The National Investor's motto is, you can get information anywhere, but here you get knowledge. And for well over 40 years now, Chris Temple has imparted that knowledge, an unparalleled, understandable, and useful take on the big picture of the markets and of our world. He has been out in front of what you see on the news every day on many themes. More, Chris has taken this macro knowledge and his unique analytical abilities to uncover unique investment opportunities. Often he has guided his members to big winners in resources, biotech stocks, and more. His talents and connections often getting him into ground floor opportunities before they are discovered. Without further ado, here is Chris with today's topic.
Welcome in. This is Chris Temple, editor and publisher of the National Investor. And in just a few minutes, I'll be joined by Ed Kovalik, who is the Chairman and CEO of Prairie Operating Company, which got an early Christmas present, not too many days before Christmas, when it got its Nasdaq listing, as you see here on the screen. I've known Ed on and off for a few years now, a couple of different contexts, but as you're going to learn, Ed, first and foremost, is an energy guy. He's got a lot of a resume in this industry, and now has got an opportunity with a lot of help and a couple of key investors to build a really nice mid-tier oil and gas producer here in the US of A. Before I bring Ed on, a few of the usual preliminaries. As you've seen on the screen here, again, Prairie is listed under PROP as a symbol on a Nasdaq. I encourage you and implore you, in fact, make sure you get in touch with the company, follow them on social media, sign up for their mailing list, etc. You've had all the information on the screen here. Now, as we go along, Ed and I may be making what are construed as forward-looking statements, so we want to let you know that, as is oftentimes the case. So we can extrapolate, we can make plans and whatnot. They work, they don't work, they take longer, whatever. So just understand that with any kind of a company, you have that dynamic. And secondly, here at National Investor Publishing, for some time now, Prairie Operating Company has been a recommended stock of mine. The company does not pay for that recommendation. My subscribers expect me to give them my best advice, which I do my best to do. But from time to time, as a follow-on to that, we do have companies engage us to do copywriting, media work, and things like that, of which this video is a part. So you've seen that here as well. There's been a lot of talk, especially when we saw the government change in the US a few years ago, that the fossil fuel industry was bound for extinction. We're all going to be driving EVs and have solar panels on our roofs and things like that. And numerous things in the recent past have disabused thinking people of that notion that didn't already realize that this was all fantasy. Eventually, we will have a larger EV industry. Eventually, we will have a lot more in the way of clean energy. But old energy, oil and gas and coal, are with us for as long as anybody doing or watching this video lives, and probably through to our children as well. And because of that, and because there was such a dearth for a while of interest in the sector, there is, I think, a phenomenal opportunity. And Prairie, in my opinion, is one of the examples of this, for companies to find mid-tier assets here in the good old US of A, ones that aren't big enough for the majors, and ones that are too big for small greenfield companies that are maybe looking for prospects down the road, but don't have the money to produce something. So Prairie, in my view, has found a really good sweet spot. They've been building a company. They just had a second major announcement recently. You're going to hear all about that. And so without any further ado, meet my friend Ed Kovalik, who is the Chairman and CEO of Prairie Operating Company. Ed, thanks for joining me.
Chris, thanks for having me on today.
Well, it's a pleasure. And this is a really cool bread and butter kind of story, pie in the sky, artificial intelligence stuff that people get gaga over, but don't begin to understand. This is meat and potatoes, building blocks of our economy and the things that we need every day. So you had an opportunity some months back, and I want to back up from that for a second, to join forces with a good management team, some well-heeled investors who saw a similar opportunity to you, and to pretty much morph a lot of good assets into Prairie Operating Company, which again just went on the Nasdaq right at the end of last year. But ahead of that, you've got a pretty good track record, largely with private companies in the oil and gas space. So give us a little bit of that background and resume, if you will, Ed, and how that all led to the opportunity to put these assets together in Prairie.
Yeah, I'd be happy to, Chris. So I've been at this for quite a long time, as you alluded to, not to age myself. But after having a long career in investment banking, I founded KLR, which was a merchant bank focused on energy in 2012. And, we went on to partner with a number of capital providers and small, private assets and owners of those assets to develop them sort of what I'll call shale, 1.0, the, initial incarnation of the shale business, and learned a lot in that process. And really, shale, the development of shale was really a transition from vertical drilling to horizontal drilling. Also, a big increase in the amount of capex necessary to do that. The world went from drilling wells that were hundreds of thousands of dollars to millions of dollars, and a lot of owners of those assets just couldn't keep up with that capex, which is when we got involved with the industry to help finance that transition. And we also did things in the public domain back before SPACs were popular. We did a SPAC called KLR Energy acquisition in 2015. We bought some acreage and turned it into Rose Hill, which we developed into about a 23,000 barrel a day company from scratch in about 18 months. So that's a great case study for what we're trying to recreate here.
Neat. Now, last summer, you had a big event, which is kind of your coming out party, if you will, outside of Los Angeles. Unfortunately, I couldn't make that one. I'm going to make the next one you've got coming up. But you displayed your wares in a really cool way. You had a couple of noted experts in the energy space, led by former Energy Secretary and former Texas Governor Rick Perry. You had a couple other speakers there. Scott Tinker floored me with his knowledge, and he since has become an advisor to the company.
He has. Scott is just a tremendous wealth of knowledge and resource, and he's been all over the world. He understands how energy is consumed around the world. Where there's energy poverty, and he has a really unique perspective on reality as opposed to a lot of what I'll call propaganda that we hear today about renewables basically supplanting petroleum products and nuclear as baseload power providers. And so Scott's been a great asset to the company.
Well, for sure. And though I couldn't make it, Connie Harrison, of course, who works with me with our media company, she was able to be there. I got a lot of feedback from her. And I watched Scott's presentation after the fact. And again, I was overwhelmed. And folks, I cannot stress enough that, and Ed put it right when he talked about the propaganda that passes for energy policy. That's a kind word for a lot of it is just, fantastical notions. But we have a rolling energy crisis in the world that has already started. We got a taste of it a couple of summers ago with record high gasoline prices in the U.S., with the big spike we had in natural gas prices. Those things are going to come back. We're going to see it replicated elsewhere. We already have with the uranium price going up fivefold from its lows of a couple of years ago, and that hasn't even started yet. So look, there's a lot of stuff that we need to understand in our world today. And again, that is that it's all about energy. The globe's growing an insatiable need for it, and I think that it's a testimony to the vision that you guys have, Ed, that you're not just building a company, but that you had guys like Scott, guys like Governor/Secretary Perry, and others who were there to help make the case, not only for Prairie and what you're doing business-wise, which we're going to get into next, but just for the broader understanding of the public. Hey, folks, we still need to run internal combustion engine cars for a long time. We still need fossil fuels for, in some areas, home heating oil and this and that. And I mean, these aren't going away, and we cannot have a healthy economy if we have policies that discourage these things while they still don't even have their act together where the EVs start. So you had your big coming out party, and kind of in a bang bang fashion last summer and into the fall, you put together, and I think it was two steps, a 37,000 plus acre, is it, package of property in the DJ base. Was the Denver, remind me what that is again, the Denver Julesburg?
Julesburg, yes.
And so that's, you don't hear that as often as you do some other ones, but it's one of the big basins out in the Rocky Mountains area. So tell us how those properties came to your attention and why you thought it was important to start with those as anchors for what eventually you hope to be a whole portfolio of assets.
Sure. So, our acquisition criteria when we founded the company and got launched in the summer was really finding an asset that was oily because we're big believers in oil as compared to gas. We wanted something that was proven, that had been developed in the past. And, the DJ, and particularly this area that we purchased, is really just an old oil field that was developed from the 50s to the 80s using conventional old technology. And that's really how every great shale play in the country is birthed. You just go back to where they've made a bunch of oil in the past. The recovery from using old technology was terrible. And you go, fracture all that rock with the latest and greatest, shale 5.0 that we're onto now, and you recover all the hydrocarbons that they left down there in prior iterations. And so we were looking for that proven nature. We were looking for something that was big enough to warrant being public, so as to give us enough running room of inventory and well locations, so that we wouldn't run out in a year or two, but we had 10 years of visible runway to go develop. We were looking for something that had good infrastructure around it, so that we had pipeline takeaway, access to power, access to employees to run the rigs and horsepower that we need. And so just checking off everything that we look for in a great asset, this fit the bill. This asset had a great birth story as well. It was formerly largely owned by Noble Energy, which was acquired by Chevron. And as luck always has it in this business, prices can be volatile. After the Chevron acquisition, commodity prices fell precipitously, and a lot of people got laid off at Chevron. And this asset was very low down the totem pole because it hadn't yet been developed, and the leases began to expire on this asset. As you know, in the way shale leases work, mineral leases work, if you don't develop them, you don't hold them with production. And enterprising landmen that happen to be some of our old buddies and folks that we've known for a long time were the guys that were in here top leasing these Chevron explorations. And so when they brought this to our attention, we were really excited about it for all those reasons. And that was a great foundational asset for us to kick off development with.
Well, and this is a recurring theme, folks. Those of you who followed a number of the other interviews I've done with company CEOs in extractive industries, typically mining, you see this resource exploration. Successful companies are those that in a distressed market, or where you have distressed companies, whatever the case may be, are able to get good assets and buy them cheap. And it happens more often than you realize. The big boys aren't always any smarter than the little operators are, and they'll get overextended in the hot market. Then they have to cut some of their projects and so forth. And so it's great that you're able to end up with assets of this quality. Now, Ed, as we're beginning 2024, you have kicked off the permitting process, I believe, to get to where you're going to be able to start drilling and doing some development work, and then eventually, of course, production. Can you give us roughly right now the expected timeline that you're looking at before you start to get some revenue out of the DJ Basin with these initial properties?
Sure. So, we filed our initial batch of permits on the acreage that we bought last summer, around the September timeframe. We actually have a hearing today in Weld County for their process to approve the first batch of 72 permits that we filed for. Once we get through today, we have a hearing on March 13th with the state to approve those permits, after which we'll be able to begin developing them. Furthermore, we announced, we're very excited about this, the acquisition of Nickel Road's assets. Yes. In the same area. And that acquisition, besides, giving us proved, develop, producing reserves, generating 40 million in net cash flow in the next 12 months, and proven reserves above 250 million in total value. We also get 62 permits in that deal of permitted, proven locations to go develop. So between those 62 permits and the 72 permits that were slated to get approved on in March, we'll have ample running room for the next number of years.
That's neat. And I was going to get to that next. I'm glad you did. So that was just what, in the last couple or 3 weeks, it was January the 11th that news came out. How did you come about across that property?
An important leg of the stool of our strategy has always been doing acquisitions. We think the timing right now in the market is really, really interesting because, as you alluded to in your introduction, there's a niche of deals that just aren't being bid in the market by anybody because they're either too big for mom and pops or way too small for public companies. And so what's happened in our industry is there's been a tremendous amount of consolidation in the public domain. Really that entails everything from the majors coming down market and doing, $50 billion deals to acquire mid caps, to other mid caps banding together to do, $4 billion to $20 billion deals. And so none of them really care about buying things that are below $500 million. And, that's too big of a ticket for, smaller entities to go acquire. So, we see a tremendous pipeline of opportunities that are, 100 million to 250, 300 million in size that we think we can acquire on similar metrics that we just announced the Nickel Road deal to. And we think the timing's right to go do that. It's just a clear roll-up strategy and valuation arbitrage when public companies trade at 5 times and you can buy things close to 2 times. When things are this good from an arbitrage perspective, the only thing is it's not going to last. So we're trying to go as fast as we can. And our model is really unique. Our business model is, besides being totally unlevered, which is a important focus of our company, having balance sheet discipline, the other focus of our company is growing our production base aggressively by recycling cash flow that we get from these acquisitions back into drilling new permitted wells and growing, snowballing that production, just like we did with Rose Hill, where we grew from 0 to 23,000 barrels a day in 18 months. So, that's absolutely unique because the rest of the peer group right now is growing anemically or not growing at all because they're faced with a lot of issues relative to, a tremendous amount of debt on their balance sheets, a tremendous amount of debt refinance overhang that's coming as maturities are coming over the next couple of years. And so industry is not chasing commodity prices and they're not reinvesting into CapEx. They're either hoarding cash to cover themselves for paying debt or paying scant dividends, which used to be sexy, but they aren't sexy in a high interest rate environment compared to 5.5% T-bill rates. So we think we can really differentiate ourselves from the pack by being unlevered and high growth.
Well, and I think that when you look, not to make this overly political, but when you look at a lot of the policies that are in place right now, that's yet another impediment to smaller operators that you guys so far are able to surmount because you've got some good pockets behind you that has gotten the company to this point. And as you said, with that latest acquisition, your price tag is twice the annualized revenue as it sits right now, when normally things go for quite a bit more than that, correct?
Yeah, this is the cheapest I've ever seen assets vend in this industry. And it's really, not only driven by the reasons that I stated, but also driven by the fact that the amount of capital that's addressing this industry has also shrunk by quite a bit. The amount of private equity AUM has shrunk by about 65% in the last 5 years. So they're, not chasing deals. This industry's also been heavily demonized, as you know. by the whole ESG mafia. So, public investors have dumped it en masse. They've come back a little bit after the pandemic, and the industry performed well, but the valuation gap as compared to every other industry on the S&P is it's the cheapest thing you see on the S&P. So there's just no money chasing it. And for all those reasons, we think that this is the time to invest. This is the time to buy in and grow, because if we're right and things rotate back in a little bit more, there's just a tremendous amount of upside in the equity.
Well, I believe it. And folks, we're going to have imminently following you're watching this video, one of my rolling special issues come out. I do these about once a year or so on different themes. We're going to be talking about energy. There's going to be a Prairie Operating Company profile in it as well. But one of the points that I make in that is a key reason why you need to take a hard look and maybe even an aggressive look at the so-called old energy theme again, is something you said, Ed, about the valuation. I mean, even if you look at all of the larger companies that have got pretty healthy balance sheets these days, are kicking out a lot of cash, but they're hoarding that cash. There's a lot of financial reasons, the shareholder reasons, everything. There's been discouraging policies that are browbeating people, whether it's pension funds or whatever, who invest in fossil fuels. And it's created, I think, what's going to be another shortage down the road, because there's just not enough money going into the ground. But when you look at the valuation today of the sector, I think the last numbers I saw, correct me if I'm wrong, Ed, was that out of the overall valuation of the S&P 500, energy companies were scarcely more than 3 or 3.5%, and yet the net earnings of the last year of the S&P 500 was something like 12% attributable to energy companies. Really out of whack.
It's really out of whack. What's even more out of whack is the physical reality of the commodity as compared to the trading market. We are net short right now in terms of storage at a historic level. We haven't been this short globally, not only in the US, but on tanker around the world being transported. We haven't been this short the commodity in about 6 years in terms of storage. And from a trading market perspective, the naked shorting of the commodity and the net long position in the trading market is where it was during COVID, which tells you that that's how negative the trading market is. So if you believe we're in a pandemic-like demand environment, then that makes sense. But of course, we're not in that demand environment at all. Demand is growing every year consistently, contrary to what IEA would have everyone believe. Right. And, they just, come and restate their estimates every year because they're wrong consistently every year. I encourage your listeners to go look at that data because it's pretty interesting. And so, we like that fact pattern. We like that demand is growing every year. We like that the markets are really net short the commodity in an exaggerated way, and we like that storage is so incredibly low that it's really poised for a bit of a comeback. And oil's cheap right now. Oil trading in the 70s on a currency and inflation adjusted basis, as compared to 20 years ago when this industry kind of kicked off with shale, is really about 20% or $20 per barrel cheaper. So, on a currency and inflation adjusted basis, this is the equivalent of $55 oil when we kicked off the shale boom. And, at that time, prices averaged in the 80s. So, we should be trading at about 100 on that basis. But, we're not really dependent on that either for our business. Our break evens are about $30 a barrel. And so we're satisfied with where prices are. We think it's good for consumers because there's no demand destruction and it's not inflationary. But people should also appreciate just how cheap it is.
Well, not only how cheap it is, Ed, but also the fact that, and I don't know if you follow my friend Phil Flynn out of Chicago. He's one of the big national energy experts. He's, I think, almost every day on Fox Business and otherwise. And he has said that because of a lot of the impediments, even for the larger companies, their mandates to return money to shareholders put relatively less of it into the ground, that just under current game plans in the industry, though we recently tagged the all-time high for oil production domestically in the U.S. around 13 million barrels or so, we're likely to lose the better part of 1 million barrels of that, regardless of price, regardless of anything, in just the next 12 to 18 months. And so it's more important than ever that we get some people, filling that gap as you guys are. Have you heard the same thing about the production trajectories?
Yeah, what's interesting is that what happened is, oil companies, when we came out of COVID, they started just drilling but not completing wells. And they've been since then completing all those drilled but uncompleted wells in their inventory. And so the inventory of these ducks, as we call them, has been gradually declining to the point where, we're getting pretty low. And the CapEx spend is also down about 65%. And so that catches up with you because shale wells decline precipitously. The shale business is a bit of a treadmill business. You have to continuously drill because, you're going to produce 60% of the reserves of a shale well in the first 3 years of its production. And the life of that well is probably 30 to 50 years. So if you don't keep up with it, the declines are really, really steep. And, we may see some of that. You've also seen, the Saudis announce yesterday that they're not going to keep up with investment in some of their fields to increase spare capacity. So, with even just flat production in the US without any decline, global spare capacity is very low, yet demand is again increasing every year because the rest of the world is energy starved. We tend to be very US centric in our thinking, but we consume a tremendous amount of hydrocarbons, and the rest of the world, is barely there. And Asia is growing astronomically, India is growing astronomically. There's just voracious demand. So, nobody knows when, but I think sometime within the next several years, we're going to see more price volatility because of how short we are in supply and productive capacity to increase.
No question about that. And again, in the special issue I have upcoming, we're going to talk about an awful lot of that. In fact, while you were making those comments, Ed, I've got a slide on the screen that I've used several times in the recent past. It's very informative, that shows overall global energy demand. And over the last few decades, its consistent upward trajectory has accelerated. You need a microscope to see how just very briefly it dropped a little bit at the onset of COVID when most of the world was shut down. But that was barely a blip. I mean, the insatiable demand, as you correctly put it, for energy globally just doesn't end. And it's not only fuel for vehicles, it's electricity, it's everything. And so this idea that we're going to easily get to this place where we're going to wave a magic wand and we're all living a kumbaya life with the solar panel on every roof and an EV in every garage and whatnot, it's not as easy as it sounds. And we found that out in many different ways in the recent past. So quickly as we close, Ed, the 2024 is going to be a building year, but also a year that now with this recent acquisition, Prairie is going to have its own revenues, which is a nice thing to hear. And then again, back to the original DJ property that you started with, as far as the permitting timeline and all of that, do you have any feel for when you might actually be getting those permits that are in the application process now?
Yeah, so as I stated earlier, I think we'll get them around March 13th, which is when our hearing is.
All right, good.
And our permitting strategy is a rolling strategy. So every time we get permits, we're going to file new permits. Right. And the way we want to manage this is that we were constantly adding to that multi-year inventory.
Okay. And I think it's important to note for folks too, with those applications, that you're operating in an area that has a long history of this kind of activity, and you don't have people with placards laying down in the middle of the road. These are communities that love and want this kind of business, aren't they?
Yeah, and that's another big box we checked in terms of buying this asset. It's in rural Weld County, which is up at the Wyoming state line. It's a 90% Republican county that's really driven by ag and oil and gas. And, we're big employers in the county, and they're very supportive. So, we are keen to not buy assets where there's a lot of conflict with people, whether that be because they're, highly concentrated population centers where, it's very difficult to operate, or because they're just politically sensitized to constantly, be against us, which we, frankly, don't want to have to fight that fight. So, we're here being cheered on by the home team, so to speak. And it's a great place to operate.
That's awesome. Well, Ed, I appreciate the overview. I know the folks out there do as well. This is a company that is operating in a sweet spot, in this case, in the energy market, able to acquire some great assets on great terms. And I've got a lot of optimism for the future. So once again, for my upcoming special issue on energy and commodities that Prairie will also have a profile in, make sure that you reach out to me if you're not already on my mailing list. And again, here on the screen, be sure that you keep in touch directly with Prairie. Visit their website, learn the story, read the presentations, make sure you get on their email list. And I will, of course, from time to time as well, be putting out updates on the company when news comes and so forth. But be sure you keep in touch with both of us. And Ed, I'm looking forward to a great 2024 and beyond. So thank you for the time that you've spent with me today, and I look forward to seeing you shortly.
Chris, great talking to you today, and thanks again for having me on.
Take care.
For much more of the National Investor's cutting-edge content and actionable investment opportunities, make sure to subscribe to Chris's free content at nationalinvestor.com. And don't forget to like this video and subscribe to this channel too. Thanks for tuning in, and we'll see you next time.